The Fed decision and this economy with Jason Schenker. He is chairman of the Futurist Institute and the president and chief economist over at Prestige Economics. Jason has been ranked among the most accurate forecasters on the street. Thrilled to say he joins us now. And Jason, there was a lot to pick at from yesterday's press conference. I want to bring you some of Powell's comments on inflation. He made the point that so far, inflation coming down, it's come without large job losses. The Fed chair also said that he's reluctant to say that the last mile of this inflation fight will be more difficult. If you take a look at the drivers of the inflation still in the system, is that your read as well?
Absolutely. I think we look at the job situation, there's still over 8.7 million open jobs, and there's less than 1.9 million people collecting unemployment. What we had was a massive backlog of unfilled jobs in the wake of COVID, something that happened across industries and something that happened throughout the supply chain in manufacturing, where you had goods in a backlog. Well, it wasn't just goods that were backlogged, like cars or forklifts. It's also jobs across the economy that just couldn't be filled because the demand was so high. And even now, with over 8.7 million jobs, there's a lot of wiggle room, because before the '07 recession, there were only about 4.5 million open jobs, and we have almost double that right now. So that's a really healthy job market. Before you'd see lots of job losses, that backlog, that 8.7 plus million extra jobs, that would have to run down even further before you'd start to see lots of job shedding.
And with that in mind, do you think that it's feasible that the unemployment rate will get above 4%? And the second part of that question, does it have to?
Well, it could get above 4%. That's certainly the FOMC member expectations for the end of 2024's rate, that we're going to be at the 4.1 number is the median expectations. But it doesn't have to happen that way, because we just have so many extra open jobs and so few people collecting unemployment that, we might just see this really good soft landing. And that's, I think, one of the reasons you see such optimism in financial markets, especially after that most recent jobs number that surprised to the upside.
Do you have some confidence, though, that what the Fed communicated, at least, that doesn't necessarily mean they're going to cut, but the idea that they felt comfortable enough communicating that, do you have enough confidence that they will stick by that?
This is a great question, because you're right, Romain. The Fed very often communicates things that they might not do, right? We remember back in September, they were communicating there was going to be one more rate hike before the end of the year, and that didn't happen. So the fact they're communicating now that there could be 3 rate hikes by the end of next year, well, the end of next year is a long way off, Romain. So, we'll see if that happens. But I think what it does directionally show us and reinforce is that while inflation is still a priority and rates might remain elevated, we see that the inflation situation has eased off, and they do believe there's likely to be some wiggle room to lower rates. Now, the timing of that's kind of the big question. I know some analysts are expecting it almost imminently. We don't think it's until at the earliest the mid-year of 2024, but lower rates do seem likely ahead, because we are likely to see a slowing of growth. But on the job scene, things could remain relatively solid because of that surplus backlog of unfilled roles across sectors.
I'm sure, as you know, there's been a lot of anecdotal reports here about certain pain in certain pockets of the market among certain households. The idea that while some of the top line economic numbers we look at certainly look healthy, there are a lot of people out there who have already retrenched, and a lot of people who are at least worried about economic conditions. Even if that worry isn't justified, the worry is there. How do you sort of factor that in the model, particularly because we're talking about something that's anecdotal and not actually hard data?
Well, if we look at some of the most important data about the health of the consumer, we look at some of the credit data we get out of the New York Fed every quarter, that household credit and debt numbers. We see that the delinquency percentages have inched up, but they're still relatively low. And there are concerns about certain areas of debt, like credit card debt. But if we look in general, most of the major pieces of the economy are still solid. And of course, US GDP driven predominantly by consumption. And here's the big secret: people with jobs spend money, and that consumption drives growth. That's why I think there is optimism for the year ahead. And if we look at things even like home prices, those are still high. Of course, there's an everything rally going on right now as well. And now we see interest rates going down, mortgage rates going down. All of those things are buoyant for the year ahead. If you were to ask me about 2024 and what I'm worried about, it would be in the latter part of the year when the election questions come up. And that's something that I think is going to be a lot more difficult to predict than when the Fed's going to cut rates.
And Jason, we don't have much time left, but I wanted to bring you something else from Jerome Powell that caught my ear. He said that this is the year when distortions from the pandemic unwound. Is it safe to say that we're actually back to normal now?
I don't think we're back to normal yet. We have 8.7+ million open jobs. That's so much more than we normally. We have almost 600,000 open manufacturing jobs. Before the last recession, we had 300,000. So you're talking about an economy that is still experiencing some distortions. We're not all the way there yet. Clearly, with core CPI at 4%, we're not back to pre-COVID levels for a lot of stuff yet. And of course, with these higher interest rates, housing, that shelter component, that's a third of core CPI, 25% of headline CPI. That's not likely to get a lot better in the near term because we've also seen construction of housing has slowed with higher interest rates. So that could keep some of those shelter costs high. And of course, apartment vacancy rates are still at the lowest pre-COVID levels since the mid-80s.
All right, Jason, got to leave it there. Really enjoyed this conversation. That is Jason Schenker of Prestige Economics.